I will start with myself. My name is Martin Bolutsky. Originally, my background is software engineering in the data science. Nevertheless, 7 years ago, I kind of like fell in love to building the product and try to figure out how to build companies. So I built two companies before. Of course, as it goes, they were not very successful, but I learned lots of interesting stuff. And 4 years ago, I became a VC in one local fund in Czech Republic called Nation One. And today, I focus on my full attention to figuring out how to support SMEs through the growth products. And today's webinar is basically my preview to tell you why I think we should do it. And we will look at some facts, and we'll look at some my theories, and we can discuss them. So if you don't mind, any one of you, do you would like to introduce yourself and tell me why you came here?
So, my name's Martin. I am originally a corporate head. Then I've done a few businesses, exited some of them. I'm kind of living in Prague now on the money that I've earned that way. And I would like to understand what you're doing because I like you and you're very enthusiastic about what you do. So I would like to understand that a little bit more. And that's why I'm here today.
Thank you, Martin. Anyone else? No? Okay. So it's voluntarily. Okay, so our aim today is basically look at two thoughts. One, why SME lending is underserved, and why we have a popularity of asset-light SMEs. And second, what the revenue-based financing is, and how we can use it, how I can help basically if you're building a small company, or you are an investor, you want to understand, okay, how I can invest in the growth SMEs because the market is, as we will see, substantial. So let's start very quickly with some context. Today webinar will focus on Europe. So we don't look in US, we just very patriotic, and we say, okay, in the Europe we have a bit of the companies. On the top, the SME are company, we probably all know, but it's good to repeat. It's our companies who have below 250 employees and below 50 million revenue. In the fact, in EU, we have 21 million of them. It's our biggest employer and the biggest GDP producer. So basically, where you see pretty much all of us work for SME in our lives, hopefully. And the fact it's really a heart of the European economy. Yeah, so it's really good to understand, okay, do they have any issues? There is any potential into them. So in the context. So, and the SME lending opportunity itself, it's a trillion euro business. We know that banks who are the major lender lends about 1 trillion yearly into the SMEs. And their reportings, there is about 400 billion on the financial gap to those SMEs. And that's one part of the whole spectrum. And there is a second part, which is a private credits. Private credits are basically private funds who basically executing their mandates. Yeah, and we have in Europe we have a private credit funds who have about 311 billions committed, again, especially for SMEs. So we can say there is a big market. So and here, so as I said, like any paradigm shift, it's building on the small incremental steps until it will happen. And what we see, like in year 1975, we didn't have internet, so there was nothing like asset-like business. Any distribution of the services had to go through some shop, some distribution channel, which was physical. So the many businesses was really based, okay, I have a restaurant or I have manufacturing. There was not much businesses who didn't produce stuff. Of course, you can remember where you have business schools, you have the salesman's problem, but even the sales problem need to sell the hard asset. So basically, Hoover or vacuum or something like that. So in my mind, the definition of digital SME is a company who pretty much started with internet. There was enabler, and they don't have assets, so they can produce digital products or digital services. But even traditional SMEs become a more asset light. Even today, if you have a producer of a creme, the creme for your skin, they don't really have a machinery. Like they go into some white label producers who has a big manufacturing plant somewhere, and they basically order from them. So which means they don't really have hard assets. And here it's a twist. The banks are still, as we remember from previous slide, banks as a backbone of the SME lending, still focusing solely on asset-based lending. So what really is the asset-based lending? The asset base, as the name kind of tells us, it's like you have assets. I believe that assets has a value, have some liquidity, and I will lend you towards that. The bad part of it, they didn't really change much of their perception what it was in 1980 or 1990 or 2000. There is many reasons to it. So I would like in this slide, I would basically tell you like what they're looking as asset, not really why. We will come to the why. And so today, if the bank really want to lend it towards an asset, for them the assets need to be something physical or something with good evidence to it. And it's usually real estate. It can be inventory in your e-shop, but it's a receivable. The receivable is the invoices you are not paid yet. Yeah, and their understanding the volume which they can lend towards that assets, it's called lend to the value ratio. It's usually exposure to the risk of asset class or asset value. Most banks, unfortunately, by regulation, they need to lower this threshold is between 30 to 50%. And there are alternative lenders. You can imagine the alternative lenders are pretty much these private credit funds, which I mentioned on the second slide. So any question about this? Because it's like, would like to have your input after 3-4 slides. So we are on top of things. Any questions?
No, not yet.
Okay. No one else? We can go. Okay, so what we are going to do about those asset-light companies when pretty much banks are in the past or they haven't figured out the way how to work with them. But let's start with the example, because it's really good to imagine what that company is. So I basically create an example company. Let's imagine 4 years old company with 30 employees, 1 million euro revenue, which have 2 products, which is kind of very, very standard company in these days in like Central Eastern Europe. We will find many of them in France, UK, Scandinavia, everywhere else. And this company, as I said, they have two revenue stream. One is digital product, and one is a consulting or service. So something understandable and something very, very generic. As any companies, they're happy to provide bespoke services to their clients. But they say, okay, I need to kind of expand. I need to have some capital, maybe for my short-term needs, but in this case, let's look a little bit longer needs. So I need to, let's say, expand to Germany. And I need money, as I said, for the international expansion and for product development. So let's say I need 500,000, which if you have an asset of 1 million, the bank will probably lend to you. So if this company will have a house of 1 million euro value, the bank will lend to it, because they say, I see assets, I see the assets, I see the lending to the value ratio of 50%, and I will be happy to lend. So imagine this company doesn't have that. So it's really like an asset-light company. So of course the company will come to the bank, and the bank will say, okay, yeah, I don't really can read you, and I'm happy to provide you only many times you probably you know that there is a kind of something which called overdraft. And in this, bank usually basically betting against what it's probably the value of the company. They really look on the accounting and in some risk management, and they can provide, let's say, 5 to 15% of their yearly revenue of the business. And it's come with some interest rate, but what the banks does to basically shift the focus from asset-based, it's a personal guarantee. So basically what they do, they say, okay, I don't really know the value of your business, but as individuals, you can basically be guarantors for this loan. So you will send me a personal guarantee. I will do some checks, and I'm kind of happy to lend to you as a person, pretty much. This is how the banks basically survive to serve the asset-light companies since the asset-light company started. Yeah, and as you can see here, let's say the company can reach to 100,000 euros. Yeah. If you're looking from the current offering of alternative lender, which are much more, let's say, flexible, but they still kind of need to understand the asset. And in their case, many times the asset is receivable. It's something to be paid to the company. Maybe you heard about the companies you mentioned, like Recap, Ancap, Roger, Clearco. There are companies who are focusing on the lending to asset-light businesses, but there is a caveat, which means they usually lend in the short-term loans, so which needs to be repurposed very quickly. And in our example, where the company has only 500,000 euro generating from product, and they can understand the product, they can understand the SaaS of it. So they will lend only to what is their niche focus. So if we go back, just so you're understanding, our exemplar company had digital product, and the digital product generate basically SaaS revenue. And they say, okay, I'm happy to lend you 30% of that SaaS revenue. Which in our case, it's just 150,000 euros. The good thing is they're stop looking at personal guarantees. They're rather basically increase interest rate, which is a good approach. It's a little bit more beneficial for company, but still, as you see, they cannot find capital for growth. And now it's a good question. Like, okay, we know who providing capital for growth. What about equity investor? The issue with equity investor, even if we look on in potential, I need to grow somewhere, is the good thing is they can provide 500,000. Yeah, there is no problem. Their aim is not to be repaid. They really want to have a 10 plus X return on the investment. The problem is they invest only 1% of the deal flow. The company need to have some uniqueness of their business model. It needs to be a huge market, and it needs to be a trendy market. Otherwise, the equity investors will not have a taste for it. Regardless, as we see nowadays, at least for the last 3-4 years, where lots of equity money come to our markets, this will not change. Any equity investor is still expecting the business who invest to have something unique to it, have something which can deliver the returns. Yet it's very hard for equity investors to justify the lending to business, even the like. Okay, another stop. Any questions? Controversial topic. Huge interest rates, especially here. Okay. Next time I need to do a more interactive. Okay, so what we really need to do is rethink that asset approach. Because as you believe, or I will try to convince you, the company is not just asset. Many times, what is really important of a company is everything what the company can do with this asset, or we can produce the value. So look at the company from different angle as lender. It's looking distinctively of four specific pillars. The accounting, it's very understood. It's basically somewhere where everyone's looking. Say, okay, if the company is in a cash, they have a big debt, has some EBITDA, which is called the profitability, and have some cash flow. This is very important part. But as we know, accounting have a timeline problem. So if something accounted by accountant and someone pushed to the government, it's already very stale. And that creates the basically the risk for the lender for the small companies, because it's not really well established. There is no trendiness in the accounting data. But where some, especially alternative lenders, expose themselves, it's a business. As their receivable business can understand your sales, let's say, can understand your product, can understand let's say the size of the market. But they're it's a little bit stuck. They also don't want to go to the risk to see how the business. And without understanding, because if you look on the like accounting in the business, it's a two pieces of the four pieces puzzle. The governance of any company has a so major role that neither if the accounting business is stellar, that any even slight conflict of interest and the management dependency can kill it. And to look on this issue, it's something where, let's say, venture capitals or private equity investors do very well. But of course, we need to figure out how to scale it down. And there is another part. Like one is the governance, and second is the team. We need to figure out, it's more in the sense how to assess the team if the team covering all necessary functions in the company. If there is dependency, if there is a good compensation, because these risks are much higher in the long-term lending than not good cash flow generation. Because if you have a company who on the paper generate nice numbers, but basically it's missing half of the major roles to be covered, or there is a conflict of interest where executive director have three companies, it will basically not solve the problem. So until you don't do a full assessment of the company as a going concern, it's very, very hard for the lender to get comfortable. So, and this is basically our problem with the shit of the thinking, because we have a 400 billion lending potential as of 2019. We don't know it's today. Unfortunately, the report is not out for 21 yet. And company to be readable or to be ready for receive the more money and more loans for grow, they need to adapt to some reporting framework. They need to create habits and don't to be afraid of share. As for any good company, like the transparency, openness, it's a stellar. For let's put it the different way. Any company who try to raise growth capital come to the VC and try to rebrand themselves to be better, just to reach that money, should rethink their process and say, okay, I would rather to be better for myself and to see and to represent myself that way. And the reporting, like let's say you can call small auditing, is the way to do it. And in this way, the lender, initially it will be alternative lender, eventually can be also the bank, will gather more data, will introduce more flexibility. In some cases, the bank will drop personal guarantees because, in the sense, the personal guarantees are burden to the bank a lot. That's why most time they will rather reject you than to sign the personal guarantee. Any questions about this? Because this is kind of like, this is the topic, like what the shift, how we can enrich ourselves or the economy to react to the paradigm shift.
So I think I understand where you're going with this, but my question here is, why do you think that banks or whoever else the lender would be willing to adapt to that new reporting framework? And wouldn't they be also limited by the current legislature?
Yeah, there is two parts. One, you are completely right. For highly regulated parts, or especially banks who using deposit money for lending, this will not change. There is basically stuck in space. It's like a change of government, so this will not change. The motivation for them to kind of adapt and to look more, it's interest rates and to looking for new business, because basically that lending, the EU lending volume, it's stuck. So they need to find a new potential to lend to grow further.
So I'm sorry, one question related to that probably.
Mhm.
In the beginning, you mentioned that there's a 4 million gap in financing for SMEs.
Yes.
So where does that gap come from? I mean, is it banks not having enough money, or is it them not willing to lend because there's not enough like counterweight on the SME side, or where does the gap come from? Because
It's coming from the statistics it's Earl Holmes and EU statistics.
No.
Okay.
I understand that you found the number somewhere, but how did it kind of come along? I mean, let's say that there's a company, and the company needs 1 billion crowns in loan, and the company goes to banks, and banks only lend to the company 600 million.
Yeah,
So
that's
the 400 million.
this will not be a case.
Why is that gap there?
The gap is one of the willingness to do a smaller deals by the bank where they can really reach to personal guarantee. So
Okay,
let's
so
say
there's some kind of threshold.
it's a threshold about how much. If you go back and say, okay, the bank can lend up to 30% of the loan to value, then there is a gap for the lending.
Okay, so the company doesn't have big enough value for them to reach certain threshold for them to be like worthwhile to lend them anything.
Yes.
And that's the sum of those small things, small companies needing money creates that 400 billion euro gap.
Yes.
Okay.
Oh,
Thank you.
Well, welcome. Anyway, any questions?
Hi, Martin. Claudia speaking. I would
Hi.
like to ask you regarding the pricing or the competitiveness of the company. The companies who do revenue-based finance, let's call them competition, they have certain pricing. And what's your advantage or compared to these companies who do revenue-based financing too?
Yeah, we can get to the revenue-based finance, but revenue finance is part of the alternative lender. So I pretty much put them in this approach. So most of them still doing short-term loans against receivables. the way, if they do it by revenue-based finance or any other form of a repayment, we will come to that. Why I believe the revenue-based finance it's a more suitable for let's say small or digital SME. So we are talking about why they cannot lend more rather than what the repayment we're talking about.
Okay. Okay. So it's about the ticket.
Yeah, it can be about ticket and can be about maturity.
Okay. Thanks.
Okay. We'll come to that. We'll just
Yeah. Okay.
okay. And now we're basically going to revenue-based financing. So what it really is, the revenue-based financing, it's a different type of repayment. It's basically saying, I will lend you money and you will repay me back the percentage of your revenue, which means we're doing some kind of like trade-off. And that's why it makes sense for both sides, because in one side, I mean, as the lender, give you more flexibility, you give me more interest rate or other ways of the value, and me as a company are more. I'm sharing basic risk with you. Most of the revenue-based financing funds today don't do personal parent guarantee, so it's not really as a term of the loan. The revenue-based financing is a repayment, but it just needs to understood like. I haven't found anyone who do revenue-based financing, even if it's small or bigger, have do a personal guarantee, because they pretty much need to understand that two pillars of that scoring of the understanding of assets, which is accounting and business. The good thing about the revenue-based finance is, as it's a repayment, it's more dynamic. It can finance even the bigger things. So the examples which I gave you previously was mostly SaaS of e-commerce, but there is a good case to financing a long-term project like expansion, product development, M&A, even buyouts. Because sometimes, and they can be combined with equity, of course. So you more understanding where really this lending for dynamic companies coming and where they. So this is the graph from Silicon Valley Bank, which is one of the biggest debt lender in the US for the startups and growing companies. And they basically say, okay, if you have a traction, you need to make money, of course, because you're sharing your revenue. And it can go very, very soon, like until you start make any money, and you can be passed up to, to be parallel with the banking. Because of the flexibility of financing and which is tied to your revenue, it's very, very suitable for many stages of companies. Of course, today, what we're seeing, they usually are tied only to receivables and are short term. But let's say if your company really have, let's say, 10 millions of revenue, you can go to Silicon Valley Bank and they will create loan for you. Today, we were looking on the companies who are much smaller, so they can't really justify a big lender. Okay, and so now we were thinking, okay, we have asset, yeah. So we need to think like, okay, what is the collateral in the revenue-based finance, and what the interest rate consists of. So in one side, the creditor need to more understand the business risk. As I said, like, if you have a conflict of interest on management, or you have a, let's say, very bad team coverage, it can potentially damage your company much harder than not good profitability, which can be a short term. And this is a really good part of the revenue-based finance, because you paying as you grow, which projected you will have a little bit more money to fix the problem. As if you compare with the classical traditional loan, which kind of doesn't care where your company is at, you can end up in troubles. And another part, interest rates are more dependable on the more, not in general, the banks works really very similar, but for you as a revenue-based finance fund, you will look on the maybe more properties and let the company to choose. So it can be how much you're lending towards their annual revenue, what part of the how big part of the revenue is repayment, and how long you lend. So there can be I will eventually share with you some Excel spreadsheets where you can play and to see what is the kind of like generalistic way how the revenue-based fund can operate. And as I mentioned a few times, like why is revenue-based finance so sexy for companies? Because there is one subtle way which called cash flow insolvency. And this is basically the time where company doesn't have enough money for their short liabilities. And revenue-based finance decreasing the risk of it. Because what happens if you have a cash flow insolvency, you need to do a fire sale. Otherwise, you will be defaulted. And to be defaulted, even from a small loan, it's a big drag for the company. It's a big drag for basically for credit scoring. It's like for the human being. If you defaulted on your mortgage and it's with some written about you, it's a kind of big deal. That's why they really love the revenue-based financing, because it's lower this problem. Because as your revenue will shrink because of some event, of course the events are cascading, but still there is more room in revenue-based finance to lowering the risk of cash flow insolvency than in the traditional repayment schedule. Any questions about that? Because this is kind of like the big point why the revenue-based finance, in my opinion, should be used more and more in the digital SMEs.
Only to understand better how it works, Martin, it's like that the customer or the company who will finance by revenue-based financing, except the fact that they will pay percentage from their revenues, do they have to pay plus the interest rate, or it's included? The interest rate is included in this revenue commission?
It basically works all the way around. The company decides the share of their revenue on the beginning.
Okay.
And that will basically calculate it on the amount to return. So I will show then on the example. Let's say, and this we'll show like the idea, or no, the system is, let's say I will borrow you, I will lend to you €500,000, and you say I want to pay 5% of my revenue and we'll start repaying 6 months. And from that setup, I will tell you, okay, you will return to me 700 and you have 3 years to do it. So as the revenue share repayment is dynamic, then also interest rate is dynamic.
Okay. Okay, but it's included in this part of revenue.
It's influenced. It's influenced.
Yes. Okay.
Yeah, it's
okay.
Definitely like if you're going here like this interest rate consists, so it's influenced by these 3 properties. Okay, maybe
Okay.
influence better word than consist.
Okay.
So I actually quite understand the whole thing, because I've been in my life, I've been at least 3 times in a situation where I would very much welcome this kind of thing. For example, once we had the deal as a company that would be very beneficial for us, but it was for an American army, and we knew that the payment would only come at once and only like 3 or 4 months after the project was finished. However, we would have to spend the money to deliver the project, a long time before that. So, we needed financing to, and strangely enough, we were actually able to lend it from a bank at the time. But my point is here that I was really surprised that the bank was willing to lend us any money because we were actually just company of two people. Everybody that was working for us, we had no employees really. We had like 50 people working for us, but it was all contracts. We only rented small office. We had virtually no property. So I was really surprised, and I think they kind of made a mistake. And even in this case, I think the whole concept is heavily dependent on how good that evaluation of the business will be, what the quality of the business evaluation will be, and if it's good, fine. If it's not so good, then it may not be worth the risk.
Yeah. My point here is more to say we should not be completely dependent on the accounting and the business, but also
Definitely,
look.
I agree with that, but we have to understand that banks are kind of really looking at accounting and numbers, and because they are very tangible for them. They are very this is something that they understand. If you start talking about business, you definitely know yourself that if you don't really know the business, they can actually very easily lie to you, and you wouldn't be able to tell.
Yeah, and that's why the framework itself and the kind of some reporting standard need to be established. Yeah, I understand that the banks will, of course, if they don't see viability business somewhere else, why change? But that's also my reasoning on the shift on the creating the gap of potential lending, which is on the market, which these private funds slowly looking at it. And just one question about the loan you get. Why me think it was a mistake? It was the loan which they didn't have a personal guarantees, or is basically it come to surprise to you, or tell a little bit more about that.
Well, we've provided some personal guarantees, but they honestly they weren't worth much at that point in my life. So I had, well, I didn't have almost anything at that point, and a friend of mine was in a very similar situation. The personal guarantees were basically worthless. We as a business had nothing. We had kind of nice business running, but this one project would be more than our annual business a year before. Just
Okay,
one project. So it was a big jump for us, and honestly, the bank couldn't know anything about the business even if I spoke to them for next 2 weeks about it. So
yeah,
we didn't understand the business. We had nothing as a company. We had nothing as individuals. I think they made a mistake, or I don't know what happened there, but it was very, very weird at that point.
Okay, because like the one thing which also happening in the SME business is sometimes they call it the blind lending. I don't know, not just your case, but many times they are so focused on the some indicators, and it can be also personal guaranteed and can be something which they found in the books, and they will basically lend towards that and not think about it much. I don't know what was the size, like, because the size is also very depends for them. But yeah, they still telling all of us they do, due diligence, they do one by one cases, which may not to be true. It really depends. Every bank's basically no one tell you what the process is. And this is something which I believe need to be changed if we want to have a system which we can believe all of us, because the whole understanding, if you're going a little bit back, to create something which everyone will transparently see. Let's say as we have accounting and we have like, okay, what's cash flow, we can very, very, very easily say what's cash flow and what's the debt. But then the devil is in details for the small SMEs. And that's it. Once I understand, like, that you can be lied to. You can be lied to accounting as well. It's harder, but you still can do it. But to capture the potential, we basically need to stop thinking only about accounting. We need to basically go a little bit as let's say, if you have of course the venture capital doing the good way, to saying looking on the governance, on the team, and on the future. So, and this process is very, let's say, very time consuming, and but making it for the digital SMEs will really be beneficial for the economy as a whole, and especially will create opportunities for new businesses, for new lenders, and even for like interactions. Any more questions, or we probably have a yes? So why I believe it's that we discussed why I believe this is good for the lender, because any lender, if it's a bank or alternate lender, they want to be paid a higher interest rate or transaction fees, which I have, whatever, and transaction fees, and to have a more insight which will lower the default risk. So that exposure, I know it sounds a little bit like naive, but if I know more, if I make sure that the governance company follows some good practices, it will lower my default risk. And that means if the lender, a bank, will learn more about you, let's say from some insights, that also can create new products. So there is a double benefit for any lender. So do you agree or disagree?
Yes, on the paper, it definitely makes sense. I agree. Real life could be slightly different, but that's a long discussion.
Anyone? Any questions? Okay, guys. Yeah, we were quick. I will then share with you. I have also the two examples how the revenue-based finance can work for, let's say, general revenue-based fund. We'll probably share with you in Excel sheet just to maybe get an understanding, and yeah, we can discuss this further. There is many revenue-based fund on the market. Yeah, this session was mostly about these two ideas. Say to come back what I try to kind of convince you or tell you about. It's mostly like where it's the underserving for SME lending, and why I believe the revenue-based finance can sufficiently solve some of the volatility and fragility of SMEs. Thank you very much for your attention.
Are we going to go through that example or not?
Yeah, just okay. Let's
Because the numbers, I was just curious because the numbers were kind of similar to what I was going through with that.
Okay, lovely. No,
army that I was mentioning.
More than happy to do so. I just it's okay.
I mean,
So
we can do it alone if other people are not interested, but yeah, I'd like to do that if that's okay.
Let's do it. Okay, as you do you see my screen? Fine.
Yeah.
So let's imagine you have a business which has a revenue of 600,000 euros. This is the configuration which you usually do for revenue-based fund. So you're saying, okay, there is some grace period or non-repayment period because you want your company to basically sufficiently use the capital. Of course, they're paying you for that. Then you will need to choose a revenue share of the company. And then obviously you need to basically estimate the growth of the business. I usually try to be kind of realistic So I saying that, and not all business is going to grow every year. There will be some kick-ups. There will be nice up and downs. And as this example basically say how the revenue-based finance will generate the higher interest rate, but also will provide the company a cushion. Because if this growth will be like that, and you will need to pay a fixed repayment to the bank, you can end up in this cash flow insolvency. And so this will be do you have a question about that? Because it's a little bit hard to the Excel. It's the bad part always for everyone. Martin?
Oh Jesus, I'm sorry. I was talking and
That's fine.
so I understand the whole thing. It makes sense. Just one question. When you were discussing the interest rates with Claudia, I understand that there is an interest rate. I mean, otherwise it wouldn't make any sense to do
Yes,
the whole thing. But how do you decide about what the interest rate actually is?
Basically, every fund will have something which which will basically decide the multiple. So let's say in this example, you're saying, okay, you want 350, and I'm expecting you will return me back 596. And this number, it's basically computed from the assumptions which you have. So basically, you can say, oh yeah, I'm lending e-shops. So I believe the e-shop has some mechanism. And so you say, okay, if I will provide him 100% of the revenue, I believe will be a 20% more risky to me.
Okay.
Yeah, I believe if they will start repayment in 12 months, there are 35% higher risk for me. And these numbers are pretty much specific to the fund.
I understand. Okay.
Yeah, and in this way, you will come up with the.
They have to kind of set up. It's like online betting. I mean, every betting company has their own.
Yes,
betting,
yes, precisely.
Yeah.
This is basically just to show everyone how this logic it's developed.
I see. Okay.
Yeah, and basically, if you will say you will do like, I don't know, 10% growth for some time. Yeah, and it's you see it's dropped. Of course, if I will say, okay, I want to only 3 years maturity of the loan, and you see you paying the highest portion on the third year to basically self-sufficiently return the capital, and again, like the interest rates go bonkers.
Yeah.
And this can be also the risk of the revenue-based finance, but most of the revenue-based finance funds create some threshold, the ceiling for the interest rates, and that's their own decisions. Yeah.
So I see this nice tab there in your file when company fails.
Yes. Basically, you imagine the same way. As the revenue-based finance lending, it's without. No, it's basically a lending to company, and company can fail. So you need to see what will happen to you as a lender where company failed. Yeah. So let's. Yeah, with the 4th year, the company dies. Returns nothing. So you as a lender basically collected some cash flow, but eventually for you it means minus 2.2%, which is like still, if the company fails and you collected 97% of your principal, you're happy.
This is a nice example. However, the company would probably fail earlier than that if they kind of lent the money to fuel the growth, and they couldn't manage the growth. They would probably go out earlier.
Yes,
Anyway,
yes.
I understand that. Yeah.
Yeah. So in one side, it's still lending. The reason why you as a creditor are basically happy to lend the money to company which is in growth scale and have but basically you're extending the potential to lend based on the insights. So we do this trade-off, but it will fail in some cases.
Yeah, I understand.
The good thing is it's as a debt, and usually the companies when you give the money and extend the balance sheets, they will not fail in first 3 months until they are not fraud. But that's all, as you said before, it's all depends on that selection and the due diligence.
Okay.
And
just one more question. In the beginning, you were showing the numbers, the 21 million SMEs. So one question is, where do those numbers come from?
So this is the class. This is the classical statistic data.
Well, I've seen several statistics, so I'm just.
No, this is like there is 21 million registered SMEs.
Okay.
Yeah, that's probably this is the definition of SME. They are biggest employer, biggest GDP producer. It's EU statistics.
So the second question related is, of those 21 million, how many are those digital?
Yes.
The typical example that you had slightly later.
Yes. So basically, we did our own estimation, and we believe it's 6% of them.
6%. Okay.
Yes.
Okay.
So there are those companies who are not producing their revenue on hard assets.
Yeah.
So they cannot really, consume the lending against those assets because they don't have them.
Okay, that's a good market.
Yeah, and I believe like this 1.5 million, in some sense, making that financing gap or that potential from the private credit funds, which still growing more than the lending of the banks.